Welcome to our channel, Finance Experts. Now let's consider what is the impact of taxes on our investments and how can we minimize our tax bill. For individuals, investment income can be a fantastic source of passive income, but it can also result in heavy tax liabilities. In order to keep more of the money you earn, it's crucial to minimize taxes on investment income. In this video, we'll go over the impact of taxes on your investments and how to minimize your tax bill. The taxes you will owe on your investments should receive special consideration if you are an investor. You often have legal options to keep more of your profits by legally reducing, delaying, or even eliminating taxes on investment gains. Knowing the best strategies to reduce your taxes and keep more of your money in your pocket pays you. Revenues lost due to taxes. The amount you keep after taxes matters more to investors than your gross income. The amount of money lost to taxes and other expenses is a significant element determining your returns, just like investment choice and asset allocation. Anything you can do to lessen the drag will be beneficial in the long term because even small quantities are able to build up over time. The good news is that you have some influence over this situation. With a little forethought, you may increase the tax efficiency of your portfolio and keep more of your profits. Are you really interested in finding ways to reduce your tax bill? Then be till the end of the video to reveal the best tips. Invest in tax-efficient accounts. Invest in tax-efficient accounts, such as pension plans or ISA, which are individual savings accounts. Such accounts' contributions are made from after-tax income, but the gains as well as investment income they generate are tax-free. Diversification of investments. Increase investment diversity by investing in a variety of assets including equities, plans, and real estate. You may spread your tax obligation issues over several asset classes, which can assist lessen the burden of any taxes on any particular investment. Diversification is essential to lowering taxes on investment income. Invest in long term. Invest longer than a year. Short-term capital gains on investments held for less than a year are taxed more heavily than long-term capital gains on investments held for more than a year. Holding your investments for more than a year can reduce your tax obligations. Do you know? You must pay capital gains tax on any investment gains if you purchase a stock and later sell it after a period of more than a year. According to current tax law, capital gains are subject to tax rates that range from 0% to 20% depending on your income. On the other hand, you will have to pay ordinary income tax on your investment profits if you sell the shares after just 1 year or less. Gains from short-term stock sales may potentially result in you being taxed at a higher rate. Invest in tax-efficient vehicles. Your tax liabilities can be reduced by investing in tax-efficient products like index funds, exchange-traded funds, and tax-managed mutual funds. These investments are meant to create long-term capital gains, which are taxed at a lower rate than short-term capital gains. Implications for estate planning and charitable contributions. Different accounts receive different forms of gift and estate tax treatment, so using your various accounts strategically based on their tax treatment can also help you establish your charity giving and estate planning goals. For instance, you could desire to donate appreciated stocks from your taxable accounts to charity so that you can deduct the full fair market value and avoid paying capital gains tax. Additionally, you can donate items and write off their fair market value or what they would have cost at the time of your donation. Even stock donations to charity are an option. Make a donation to a 529 plan. Contributions to a 529 plan can reduce your tax burden if you have one or more children who will attend college in the future or who will incur other qualifying educational costs. These plans stand out because you can make significant contributions to them. State laws and regulations differ, but many jurisdictions let you set aside hundreds of thousands of dollars in a single account. Before being used for eligible educational costs, the money in the account can grow tax-free. Observe your dividends. Regardless of whether you accept the dividend in cash or reinvest it, every time your investment delivers a dividend, a tax of some form will be incurred. You will be taxed each time high dividend-paying stocks or corporate bonds make a profit if they are held in a taxable brokerage account. As we've previously discussed, it's crucial to understand each account's tax position before adding any specific investments. Furthermore, holding your investments for a long time can make your dividends qualify as dividends. In this context, extended period means at least 61 of the 121 days, starting 60 days before the ex-dividend date of the investment. If you hold the underlying investment for a long enough period of time, eligible dividends are taxed at a lower rate, similar to long-term capital gains. Holding on to the money you invested long enough to qualify your dividends is a wise investment because regular dividends will be taxed at a higher rate. Contribute to a health savings account. You can set away pre-tax money in a health savings account or HSA and use it to pay for both short-term and long-term medical expenses. You must be enrolled in a high-deductible health insurance plan to be eligible for an HSA, but if you're under 55 and have self-only coverage, you can contribute up to $3,600 this year. If you have family coverage and are under 55, the upper limit is $7,200. Additionally, if you are 55 years of age or older, you may contribute an additional $1,000 on top of the existing cap. The money you invest in an HSA is income that the IRS cannot tax you on, just like a standard IRA or 401k, making money off of investment losses. Selling off investments that have lost value since you bought them can also enable you to pay less tax overall. This tactic is frequently known as tax loss harvesting. Up to a specific amount each year, these investment losses may be written off against your investment earnings or other income. This limit is imposed by the Internal Revenue Service or IRS at $3,000 or $1,500 if you're married and filing separately. Additionally, you can carry over any unused funds to future years to lower your taxes at that time as well. Contrarily, delaying the sale of an item that has increased in value can help you avoid paying taxes on the gain, especially if it's a year when your taxable income is higher. Find the high cash suppliers. To draw in income-seeking investors, some investment entities such as real estate investment trust REITs can advertise substantial cash dividends. These are totally acceptable investments, but you should be aware that if kept in a typical taxable brokerage account, the majority of REIT income will be taxed at conventional income tax rates. Passive ETFs that primarily profit from capital gains are typically better suited for taxable accounts, while assets with substantial cash dividends are typically better off in tax-deferred accounts. Broad index passive funds typically offer smaller payouts, but make up for them by offering long-term price growth. How can a company reduce annual tax bills? Tax obligations come with operating a business, but with careful planning, this expense can be minimized. Businesses can reduce their tax liability just like individual taxpayers by understanding and claiming the appropriate deductions, such as those for travel expenses, wages, and the standard mileage rate. Applying tax credits to lower the year's tax liability might also be beneficial. Other actions that firms can take include hiring more staff, purchasing equipment, raw materials, and other crucial assets for their operations at the appropriate moment. Business owners might wish to think about discussing their alternatives with a tax expert. There is a very good likelihood that you will owe taxes if you have a source of income. Taxes must be paid on any income received from an employer, but let's face it, nobody wants to pay the government more taxes than necessary, especially during hard times. However, there are few methods you might lower your tax obligation. The actions mentioned above can definitely reduce your tax liability. However, if you can afford it and feel that you will still have a significant tax burden, you might want to think about having your employer deduct more money from each paycheck. So, did you get a clear understanding of how to manage your tax? Then take steps to reduce your tax bill by these steps. Thanks for being to the end of the video. Don't forget to like, share, subscribe, and tell us what you think about this video below in the comment section. Thanks for watching. We'll see you in the next video.